Hey guys and girls, Birchy here. Today talking about the difference between $1 million property versus 4 times $250,000 properties. A few of these things I can put in visual and a few of these things I'm going to have to explain to you guys, right? So let's follow through. Let's say you go and buy a property for $1 million, right? Cool. 6% interest is $60,000 a year. Expenses, let's call it 10 grand a year. That's $70,000 a year worth of expenses. Let's say you get a rent of $700 a week. I know what people are saying. There's lots of variables here, right? $700 a week, that's pretty fair in most capital cities or whatever, right? There's only a certain cap of where people can go and pay for rent on a property. So that's one of the hurdles that you have to come across, right? But let's say you get $700 a week. That's $36,400 per year. 36 minus 70,000 is about $34,000 negative cash flow per year. There is your case example on the first one. Now, if we went and bought 4 little shit ones that are over here, and let's say they're 250 grand a piece, at 6% interest, there's $15,000 a year worth interest. Let's say with these ones, the expenses are only about $7,000 per year. That would mean that we're $22,000 a year for the outgoings on that property. If the rent is $450 a week, which is very fair and reasonable for a $250,000 purchase in 2025, that would mean that you'd be getting about $23,000 per year. So that would be neutral cash flow roughly, right? So you could have one house versus 4 little other properties, right? Now the parts that I can't put in here that we're going to have to walk through and explore is a few other options. So let's assume that you're buying this house to live in, right? That means if you're buying this property to live in, it's going to look even a little bit worse, right? Because on this $1 million property, you're going to need to put in a 20% deposit. So you need about $200,000 to get into that deal. Have you got 200 grand a day to get into the deal? Plus closing costs, maybe stamp duty, legals, whatever, maybe another $50,000. For a $250,000 property, you need a $50,000 deposit to get in that property. Much more reasonable, palatable, and affordable, and realistic. Now, if you're going to live in this property, you're not getting the rent, so you're really out of pocket $70,000 a year for the pleasure of living in your $1 million property. If you've now got these 4 properties over here, you've got 4 sets of tenants, they're going to work every day, they're going to be earning the money, they're going to be paying it to you, you're out of pocket nothing. You can go rent this property for $36,400 a year and be $34,000 better off by doing so and doing rent vesting model. The second option, the second thing that I'd like to consider in this as well, is that you've got 100% exposure into that one property. So what happens if the market doesn't grow? What happens if there's a recession in that market? What happens if something hits that area or location? Where here you've got 4 properties. So you've got risk diversification. You've got asset spread that's across multiple different assets. That's one aspect of it. The second one is liquidity. The third one is liquidity, right? Let's say you go, okay, this property's gone from $1 million to 1.5 to 2 million. They've both doubled, whatever, right? You get yourself in a bit of trouble one day. You go, I need $200,000. I'm going to have to sell my property, right? You might have gone to $2 million. You sell it, now you're going to execute, capital gains taxes and trigger off a whole pile of other alarm bells. Here, you've got it spread across. You could sell one of these properties off and still have 3 of the properties sitting there and be in a great position as well. Now, this is where the real important part kicks in, right? Let's say you buy this property for $1 million and you get $100,000 equity out of it, right? You're only getting half of your money back here, right? Let's say you buy 4 of these properties for $250,000. We'll take a little cross off him. And you've got these properties sitting here and they're $250,000 and you've got $50,000 equity in it. You've got $50,000 equity across 4 of them. That's all of your capital back that you put into those deals. So it's easy to get your equity out to go again. The other thing that the bank looks at is when you're going to buy these type of properties is they're looking at your cash flow position. Over here, it's going to be stripping out most of your serviceability. Over here, this will be improving your serviceability and making your position look more attractive when you go back to the bank and ask them to lend you some more money. The other aspect of it is, let's say rent increases. Right? This one here goes from $700 a week to $800 a week. Woo! You got yourself $100 a week extra cash flow. Great. On these ones here, are you going to go $100 a week? Maybe, right? But let's say you don't get $100 a week and you only get $50 a week. $50 a week times 4, you've got more hooks in the ocean. You can catch equity, you can catch growth. This one may go up in equity, this one may not this month. So you can go and pull the equity from this one. But your rent, if you're putting $50 on each one, you're now getting $200 a week in extra rent versus the $100 over there. And that's what I've personally seen in my portfolio of having hundreds and hundreds of properties over 22 years of investing. If you want help on building out a strategy, these properties work good sometimes, these properties work good other times. If you want help building out that strategy that's tailored for yourself, reach out to us 1300-367-925 and hit us up, have a conversation and see what we can do and what works best for you. Thanks for watching. Have a great day.